Okay, well, welcome everyone to the afternoon of Track 2B. The main topic for discussion for this section is discussing opportunities for green bonds, green bond markets in the region. And I think it's really important to kind of contextualise the importance of this particular financial segment. So. According to the International the International Energy Agency, 53 trillion investment is required in order to meet the goal of 2 degrees C warming. That's a huge amount of money, up to 2035. And to put that in perspective, the bond market is currently around 90 trillion. So the sheer amount of funds that need to be mobilised to ensure that we can meet those climate targets is immense. This section will talk about how international discussions are shaping green bonds. We'll discuss measures and options to address how we can actually scale up green bond investment in the region, and also the kinds of difficulties that are real and in some cases perceived to be there in terms of mobilising green bond markets. So that's briefly where we'll go. We've got a fairly tight agenda. I now call on Jonathan Drew, who is going to provide a short presentation to basically set the scene for today's discussions. Thanks.
Noel, thank you very much, and ladies and gentlemen, good afternoon. I may, as a first piece of housekeeping, I'd like to rename this session from Track 2B to Track 2C, because I think that clearly is perhaps what it's all about when we're talking about green bonds. And the fundamental proposition here, as Noel has described, is a green bond as a crucial instrument and facilitation of this hugely critical transition from today's high carbon economy to a low carbon economy. Noel touched on some of the numbers there. The volumes of investment required are simply enormous. Numbers up to $5 trillion per annum to facilitate this transition. And of course, as we've heard in sessions yesterday and earlier this morning, the capacity and the capability of the public sector and the traditional development bank institutions to finance that transition are very significant, but they run to perhaps the tens or hundreds of billions. So in order of magnitude, we're about a factor of 100 between the funding that's available from the traditional institutions and governments who've supported these types of transactions, and actually the investment and the financing that's required. So the question really is, how can green bonds and the private sector facilitate that transition? The concept of 2C, I think, probably for a group like this needs very little introduction. I think we know what 2C is. I think we know why it's very important. I think we probably all know what's causing temperature rises. I think we probably all know why carbon dioxide is a greenhouse gas, why methane is a greenhouse gas, and why one burns up in the atmosphere rather more quickly than the other. And that science, which of course is behind the climate challenge, is I'm sure well known to everybody in this room. But it is probably just worth remembering when we're talking about mobilizing a much broader and enormous private sector, and the markets represented by people who are not in this room, is that scientific understanding is probably not well held, not well understood outside of a relatively small community of the species or the species of Homo sapiens or a small proportion of humanity. So we have to recognize that in considering how we can mobilize the capital markets to the challenge ahead. I think I've noted over the past few days the extraordinary efforts that have been made by many, including development banks, but also other institutions, in delivering some quite extraordinarily successful projects that have fundamentally changed and contributed to addressing this challenge with our ecosystem, and heard many of them then talk about the challenge about how that can be scaled up. The unfortunate reality is that challenge is a tough one, and when we look at the impact that we've had today, or the success we've had today on an aggregated global level, we still see as a society that we are still emitting today 55 gigatons of carbon dioxide equivalent approximately. For those of you who, like I do sometimes, look at the Keeling curve, the concentration of CO2 in the atmosphere, I think this morning was at about 404 parts per million, and it's increasing at about 3 to 4 parts per million per annum. So I would suggest that many of the successes of ultimately addressing this challenge for humanity, those lie ahead of us rather than behind us. Perhaps what is also not very well understood outside of the confines of institutions like the ADB and also the expertise that sits in this room is just the urgency of addressing this challenge and the imminence of the impact, and if we just look at climate change itself, the imminence of the impact of these increasing carbon dioxide levels. Science has indicated this sort of amber warning zone of 350 to 450, as I mentioned earlier today, we're at 404, and the maths that takes us from 404 to beyond the amber zone and into the red zone, where science is saying we have some really serious risks. We could be moving out of the amber zone and into the red zone in, frankly, not too much more than a decade or so. So the need to put our foot on the brake and to brake hard is now. So, green bonds, where do we start? A market today, there are about 120 billion green bonds in issuance. As of today, the market's been growing very rapidly. When we look at the recent trends, what have we seen? I think the big change this year has been the emergence of China, and this is the pale blue block you can see in the far right column. China has really stepped forward and stepped up to grasp the green bond as a product, as part of a much broader process of utilizing the financial system to drive this transition. And of course, China's paper issued just after G20 that summarized their approach to greening the financial system was truly dramatic, broad and deep in content: green equity, green loans, green bonds, of course, green insurance, green PPP transactions, and so forth. This has been a major driver. Other features I think we can see in the market as it's developed is, of course, the transition from those early pioneers of green bonds, the sub-sovereign agencies or the development banks, a couple of whom are represented here on the panel. We've seen their early work resulting in very successfully now a much broader base of issuers, as we now see corporates and commercial banks now representing more than 50% of new issuance in this year. That's a very important development as we move towards this concept that many have touched upon of mainstreaming the green bond program and mainstreaming sustainable or green business. The Climate Bonds Initiative, last year, and I think as they reiterated on their blog again this morning, have set a target that we should have $1 trillion of green bonds issued by 2020. So I think, again, that just reminds us that we are, although we're growing in a market that's growing, we're starting from a very low base indeed. And the issuance of 120 billion is perhaps only 0.1 or 0.2% of the total global capital markets, or the total bond markets as they stand today. Where will we go in the future in terms of who are we going to see starting to issue come forward? I think we will continue to see this drive of private sector issuers, but I think also one notable party that has been absent as an issue are sovereigns themselves. I think we're about to see, touch wood, we hope to take the first sovereign to the green bond markets before the end of this year. At the moment, it looks like that will happen in Europe, but certainly across Asia as well. We have many dialogues with numerous what we might call developing country sovereign ministries of finance as to how they can utilize the green finance product, again, as a platform to describe the crucial sustainability challenges that face them, both in terms of mitigation and, in many markets, adaptation, and the financing requirements for those to address and to make those investments. In terms of sectors, very briefly, the pie on the right talks about the labeled green bond market. These are the bonds where there is a clear identified use of proceeds, typically provided by the issuers under a green bond framework or a green bond management statement, so a statement, a set of representations made by the issuers to their investors. Many of these, you can see the biggest chunk here comes in the multi-asset category. This is largely driven by the commercial banks, and again, a large proportion of this is the Chinese banks who've issued this year, with very broad frameworks under which those banks will then allocate the use of the proceeds of those bond issuance across a wide range of green sectors, which you can see on the graph here, obviously including energy, transportation, energy efficiency, buildings, as well as some of those emerging natural capital sectors where capital is increasingly being applied. The climate-aligned bonds is the broader universe. The other issuers in here, you can see the little blue chunk on the left there is of the multi-asset classes, is effectively correlates to the 49% of the labeled bonds. The larger proportion, though, of the climate-aligned bonds are issued by what the Climate Bonds Initiative, who put this report together, have identified as the pure play entities. So if you're a pure play rail company, a pure play renewable energy company, those bonds are tracked here, and that universe is now approaching about, as you can see from the numbers here, about $700 billion US. So the question really, I think this slide talks to is where do we go next? The categories, if we look to the green bond principles, which I think still provide the best framework for determining what is a green bond and how is a green bond governed, you can see amongst the categories here, those that I mentioned. I think where we will start to see more activity as we go forward, one area will be, I think, mass transit. We brought Hong Kong MTR to market just a couple of months ago. I think we will see mass transit, and in terms of this mainstreaming, mass transit in an environment where more than 55% of the population is now living in an urban environment, and where we're seeing massive growth of urbanization across many Asian markets. Mass transit is one area where we can make very big gains in terms of carbon avoidance versus a business as usual approach with vehicle transportation. So mass transit will be very, very important. I think we'll also see growth in the water and waste sector. Climate Bonds Initiative have done a lot of good work around starting to establish some principles around the water sector, which is of course leading to giving investors comfort about the genuine green nature of an investment in a green bond. There are indeed some sectors in here which we might call slightly more controversial, or perhaps rather than controversial, where there are different opinions as to the greenness. These would include clean coal. I think there's probably a universal agreement now that we shouldn't probably include clean coal as a green bond usage. Somewhat more grey would be the transition or the displacement or the substitution of coal-fired power with gas-fired power. Methane, of course, burning much cleaner. I think we will probably see perhaps the emergence of a new type of category or a subcategory of green there, because I think across many Asian markets, hydrocarbons are still going to be very important as a fuel source, and the financing or the supporting the transition from the very high through the let's call it the middle ranges of gas-fired is an important transition step to growing and creating wealth in emerging markets, ultimately facilitating over time a transition to a much lower carbon output. I mentioned MTR in Hong Kong. Again, I think this is noteworthy, because not only are we now expecting to see and seeing increasing demand from many provincial and municipal governments in China looking to adopt the approach that MTR took to raising green capital for their transactions, but it's also as well raising some very interesting questions about how the Hong Kong Rail Plus property model might be deployed, and it will need to be tailored again to addressing the low carbon, high density development of urban areas, which is of course critically important in China. Another transaction which I think is noteworthy, the question around brown companies. Can brown companies issue green bonds? I think the answer is yes, but again, all opinions are welcome. The National Thermal Power Corporation of India, I think, was a very interesting example, a company that whose core business is generating electric power, most of it by burning some lower calorific value coal resources in India, but set up a special unit to develop in renewable energy, and a transaction which many of us thought quite carefully about before we took this to market, but actually was very well received by the investor base, and therefore NTPC have now created or really opened up the offshore Indian rupee market in green format, so an inaugural green masala transaction here. So a notable recent deal to observe there. A key issue, and I know investors will be thinking very carefully about this, is assurance. I think a number of assurance methods have now become quite well established, but it is still an evolving process. The so-called second opinion, where the ESG consultant provides an opinion on the likely environmental benefits of the actual use of proceeds, as well as an opinion on the conformity of the bond transaction with the green bond principles. This, I think there were some weaknesses in this approach, quite rightly identified by the Climate Bonds Initiative, the fact that in many ways the standards that the ESG consultants are using were not transparent to investors. So the Climate Bonds Standards Board set up to provide standards across the key sectors, make those public, increase transparency. Moody's then joined the party with their green bond assessment methodology, and this was really the first in a movement towards an assessment in a sense of how green is a green bond. I think there have been probably half a dozen transactions where Moody's have rated them. People will have their views on this. I think from the private sector issuer perspective, there are some concerns about this methodology because it's yet another rating that they have to manage. My own personal view is I would really like to see the credit rating agencies focusing on what's actually the sustainability risk in the entities they rate and how does that impact on credit risk, because that seems to me the way that we will mainstream that. Clearly, and there was a reference on the earlier panel to what Standard & Poor's are now doing, and very interesting that they're, of course, now working with, or True Cost is now a part of that, because I think this methodology is moving in the right direction, where they're now looking to add into that some robust evaluation of, or quantification of the benefits of the projects to which green bond proceeds are applied. So I think this is quite an interesting development when Standard & Poor's and True Cost bring this product forward. The final point I wanted to make was just to talk about disclosure. Green bonds, as was again very well described yesterday, it's really a green bond is the same as any other bond, with the exception of the fact that the use of proceeds are identified and allocated to eligible green investments. And of course, what that really means is that a green bond comes with extra disclosure. And this, I think, is one of the neat features of a green bond, that a green bond, as the tables at the beginning showed, has proven quite flexible in both its application to, let's call it a sort of Western type market approach, or a market type approach, where the market needs information such that the players can then make decisions based upon that information, hence why disclosure is important. And also in a more planned type environment, notably China, where, because of the use of proceeds component in a green bond, the market regulators can clearly then direct the market to support the transactions where those use of proceeds conform with the broader sustainability objectives of the country concerned. And China has proven very effective as well in using its regulations, and you won't see this written anywhere in the regulations, but using the regulations to facilitate transactions which come forward in green format, securing much more prompt and efficient approvals through the process than transactions that are not done in green format. So this is how China is using the green bond product, using the system to direct capital into sustainability sectors. I think perhaps just to conclude, though, and on disclosure, and I know some of the panelists this will be very dear to their heart. I think disclosure is not only critical in green bonds, but disclosure is really critical across the whole of the financial markets. We, as a large commercial bank, we are now through the FSB, and under that the Task Force on Climate-Related Disclosures, undertaking a huge exercise as to how we disclose not only our own direct emissions, which we have a pretty good handle on, plus disclose the emissions of our clients. And I think where disclosure really gets us to, or where we might hope that disclosure would get us to, is to that point where, if we get disclosure right and if we get the accounting right, that will then facilitate actually what I think is really needed to ensure the transition takes place at a pace and within the time frame available, which is ultimately putting a price onto carbon. So putting a price on carbon, disclose it, that will facilitate taxation to be applied, and that monetization of carbon, not just valuation of carbon, but putting a monetary value on it, which can then be realized in the form of money that can be used in whatever exchange is required. That is when we will really see the private sector move capital to sustainable activities. So that combination of carbon pricing, probably through carbon taxation, plus this huge pool of capital, this $100 trillion bond market where 1,400 of money managers representing something like 60 trillion of that capital have committed to, in various different forms, to make sustainable investments. That, I believe, is the true and valid and way we will see this transition occur, and is certainly the source of my own personal optimism. So thank you very much.
That's good. Thank God for Sean. Thanks, Jonathan. I think that was a great introduction to the discussions today. We're just going to call the panellists up now, who I think are going to be introduced by our organisers. Is that right?
Okay, for our panel discussion, we'd like to call on Gregory Schneider-Manauri, Head of Sustainable Responsible. We would like to call on Christopher Knowles, Head of Climate Change and Environment Division, European Investment Bank. Next, we'd like to call Professor Atiur Rahman, Department of Development Studies, University of Dhaka. Last but not the least, we'd like to call on Mr. Anthony Rushpler, Treasury Specialist from the Asian Development Bank.
Okay, so what we're going to do now, we're just going to briefly hear from each of the 5 panellists. They're going to provide their perspective on developing the green bond market, and they each come from a different perspective, so it should be very interesting. Actually, it's 4 because we've already heard from one.
So you don't want to hear from me anymore.
So 5 minutes?
Yeah, 5 minutes.
Good. Yeah. Thanks everybody for attending. Thanks to the ADB for the invitation. So in 5 minutes, so Humanis is a French asset owner, and we have designed and we manage internally a green bond fund of 150 million of euros. It's one of the biggest green bond fund in France. It's the only one in France and probably in Europe that measure its environmental impact. We're proud to say that for every million invested, 1,400 tons of CO2 are avoided per year. So, 4 minutes now. Why we do that as an asset owner? We don't do that because we are French, because we are inspired by a moral or anything like this. We just do that because, as an asset owner, we acknowledge that environmental and social issues have an impact on our bonds, and probably much more on bonds than on equity values. So, based on all this social responsible investment trend in Europe for 10 years, 15 years now, we have gone a bit further through the COP21 in Paris, and with many other investors, we decided to measure our own CO2, our own carbon footprint, the carbon footprint of our portfolio. Because what we discovered is that the carbon footprint of our portfolio is much more important than the one of our operation. It's 30 times higher than the one of our operations. To say it in other words, 97% of our carbon emission are linked to the one in our portfolio, in our equity portfolio. So it's important, if we want to do something for the reduction of carbon emission, to do something also in our investment decision. And that's why we focus on Green Bond Fund on CO2 abatement. So how did we do that? We use the Green Bond principles that Jonathan clearly described a few minutes ago, and we considered that usually, so far, green bonds are talking about climate change. And as there is an analysis and a quantification, if you want to quantify something regarding climate change, it's the tons, the unit is a ton of CO2 avoided. So asking that to issuers enable us to consolidate that And that's why we can say that in our whole fund, we have this result of for every million invested, 1,400 tons of CO2 are avoided. That's not something that we measure in the corner of our table, but we ask TrueCost, which already present its services and skills this morning. We asked TrueCost to make this measurement. So it's not something that we just cook in our book. It's something measured by external independent advisor. So now, maybe the last question, and 30 seconds, why do we consider that Asia is important for green bond and green bond is important for Asia? Well, green bond enables to go beyond all the question of CSR, CSI, CSP. I've heard a lot of new acronyms this morning and yesterday. Green bond enables to go through towards impact investment. And impact investment is something that can be globally understood. Tons of CO2 is a unit that could become, tons of CO2 avoided is a unit that could become universal, global. And Asia is important for this green bond market to become global. For sure, Asia is also important for us because as we are focusing on CO2 abatement, the greatest CO2 abatement potential is in Asia. So that's why we would like Asia and Asian companies, Asian banks to issue green bonds, Asian small companies to identify this project and ask ADB or other bank to finance it. That's all. Thanks.
Can you drive my slides for me down there? Thank you. So I'm going to use just 4 slides. If you can go straight away to the next one, please. And I want to make 3 points, really. I want to give you a quick recap on how we got to where we are today. I want to talk to you about impact reporting, which is absolutely integral to this product. And I want to talk quickly about the green bond principles, which are part of the reporting and integral. So back in 2007, there was another multinational, large multilateral, who claimed to do the first green bond, but please believe me, it was EIB. And we had a very lonely 5 years, which wasn't helped by what was going on in the markets at that time. But starting in 2013, we began to see some growth in the market. We began to see some institutional and bigger retailers coming in. And starting 2014, we saw a much bigger acceleration in the growth. And also in 2014 was when we got the first iteration of the Green Bond Principles published. And I will talk about that in a minute. Our attitude, our stance towards the green bond market has always been one of development. We have not actually had any material benefit. We don't gain anything by issuing green bonds. It actually costs us more to do so, but we believe it is worthwhile to do so. And if I tell you that our green bond issuance over the time of that curve is about less than 15% of our green bond financing, you can see that most of our green bond financing has been out of conventional brown bonds. Next one, please. This is basically a quantitative illustration of where we are trying to help on the development of the market. Markets need diversification, they need liquidity, and they need tenor. They need a yield curve. So what we can point to at the moment, other than the geographical distribution you see there, is we have got a 21-year tenor sitting out there. We have 12 years, 8 years. So we've got a yield curve now for long-term assets. And we've also got some very big issues. We have a 3 billion issue due in 2019. And once a market has 3 billion, it feels that's a liquid issue. That becomes a tradable security. Turning to impact reporting, when we started the detailed reporting, when we started in 2007, we initially reported only on a portfolio basis. But starting in 2014, we switched, and we can now link every dollar we raise from a green bond issuance to an individual project, and we can report on the performance of that project to the buyer of that bond. It's quite an extreme kind of reporting, but we have certainly found it is helpful to the marketing of these bonds. People feel very comfortable when they can have that kind of information, when they can see that kind of linkage. Bear in mind that they are always coming through EIB's balance sheet, so they enjoy the AAA rating of the EIB, but at the same time they can also see the individual project that their dollar has gone into. And they can also see the impact that that project is generating for their dollar. It's a surprisingly complicated exercise to translate dollars of capital expenditure into impact, but you see two measures there. We do it on a relative basis against some kind of baseline scenario. So for every €1 of disbursement, we're averaging at the moment 388 tons of CO2 avoided, and we also then have an absolute greenhouse gas emission rating right across our portfolio. And this is reported on twice a year now, and there's a newsletter. Buyers of these bonds can also go straight into our website. They can feed in the number of the bond into the website, and they can see it online in real time. My last slide then, the green bond principles. This is a voluntary coalition of banks and issuers and investors. It builds on practice that we developed over the years from 2007. It started really in January of 2014. Just 4 banks, Bank of America, BAML, Crédit Agricole, JP Morgan, and Citi. As of this year, middle of this year, it's now 122 members and 75 observers. It's not mandatory, it cannot be mandatory, and we think it would be too early to be mandatory. It's important at this stage to keep flexibility in the market. But it does set out best practice for issuers, and also it's important, I think, for investors, because you heard yesterday the reference to the pajama guys. We sometimes talk about the 1-minute investors. Many investors have a limited capacity to understand the technicalities of this stuff. They want an instant, quick certification, and the green bond principles are one of the ways in which they can get that. I finished. Thank you very much.
Thank you. I would like to bring in developing countries' perspectives into this discussion. As a former regulator, a money market regulator, governor for 7 years, I have seen the financial market from a very close quarter. And as I told you yesterday, countries like ours is essentially overwhelmed by the banks, where capital market is still very, very thin, and most of the finances still coming from the banks. And we, in our modest way in Bangladesh, we try to nudge the banks to become socially responsible, to provide even the green finance to small and medium enterprises and some frontier industries like the textile industries. But learning from those lessons, and we can we should be ready for moving into the capital market and also raising green bonds. As you all know, countries, most of the Asian countries, we are going through 4 critical transitions. The first one is that we are going for a fast urbanization, and the urbanization is taking place pretty fast. Secondly, we are going through a manufacturing takeoff, industrializations. Bangladesh particularly is going through a textile takeoff, manufacturing takeoff. Thirdly, we are a young demography. 50% of the population are below 25 years. They have a different taste. They are really emerging as a global millennials. So these are thirdly, we're going through a technological revolution. Everyone has got a mobile phone, and they really shape their lifestyles based on that. So these are the transitions, and these transitions will need to be negotiated. And for that negotiations, we need huge investment. And this conventional investment, bank-based investment probably will not do. And for that matter, we need to go for a bond market. And again, more particularly, we need to go for green bond market, because we really aim for sustainable cities, sustainable development, and for that we need this kind of transitions that we are now talking about. But problem with the countries like ours is that our conventional green market is very, very limited, pretty thin. Even the secondary market is not even there. So that's the challenge we need to overcome. And for that, we need to really work with people like you to understand this market and really take it forward in terms of, proper standardization, appropriate regulations, disclosures, the awareness we need, and the governance issues. All these need to be really considered and taken into consideration if you want to jumpstart into the bond market. If the conventional bond market is not well developed, it will be very difficult to even start the green bond market. So I thought we need to walk on two legs, both the conventional bond market and then transform part of this into green market. And for that matter, we need to build the capacity of the financial institutions and with all the regulatory support and also fiscal support. As you all know, yesterday I was talking about the tax incentives. In India, the Indian Renewable Energy Development Authority, they issued a tax-free 50 million green bond this January. And would you believe it, this has been oversubscribed by 5 times. Because the net yield at the end of the day is much higher than the fixed deposit return that they get from the bank deposit. So if you can build in those kind of fiscal incentives into this kind of bond market, then you get a much better results at the end of the day. And also in India, Jonathan was mentioning about it, the masala bond. The IFC bought the entire rupee bond and then issued this rupee denominated bond in the London Stock Exchange, with the Yes Bank, and that's how they really avoided the currency volatility risk, and that's how you can move on. Again, in Bangladesh, we have huge SMEs, small and medium entrepreneurs, and if we can bundle those SMEs and take their cash flow into our consideration and securitize them, there is a huge opportunity of moving just for the SMEs. We can go into this kind of market. Again, finally, I would say that there is an opportunity of using the insurance for really reassuring or reinsuring like the ARC has done in Africa for really jumpstart of the green market. And I didn't mention about sukuks. About 20% of our market finance is still Islamic market, and there is a huge potential for green sukuks in our market and also in many of the developing countries.
Great. Good afternoon. I'll be giving an overview of ADB's specific activities in the green bond market. I've actually prepared a couple of slides, if they can come up. You didn't receive the slides? Or, okay. No? Slide? Okay, no slides. Well, let me try and do it without it. So, quick overview. ADB is a frequent borrower in the capital markets. Like EIB, we have a AAA rating, and our funding requirement for 2016 is in the range of $20.5 billion. So green bonds make a component of that. Actually, green bonds are not the first time that we've come across a group of investors who wanted to make a difference with their investment. We've actually been active in clean energy and water bonds back in 2010. We issued some $900 million worth back then. But this was mostly directed into the retail investor base in Japan. So quite a specific requirement from their side. In early 2015, we actually started to set up our own green bond framework in order to tackle 3 objectives. We wanted to diversify our investor base to a growing class of SRI investors coming out of the US and Europe. We also wanted to raise cost-effective funding from the capital markets and raise the profile of ADB's green activities, green projects. The Green Bond Framework itself was given a second opinion by Cicero. I think that was mentioned in one of the earlier presentations. Cicero opined on the robustness of our Green Bond Framework to deliver the environmental objectives set out therein. Our framework also followed, again, what was mentioned earlier, the ICMA's Green Bond Principles. And the Green Bond Principles, just to reiterate, provide a set of voluntary guidelines on the use of proceeds, the process for project evaluation and selection, the management of proceeds, and reporting. Now, in terms of our eligible projects, those that we can include in the Green Bond portfolio are those that promote the transition to low carbon and climate resilient growth. So for us, that means mitigation type projects, including renewable energy, solar, wind, geothermal, and small hydro, as well as energy efficiency type projects, excluding fossil fuels, as well as sustainable transport. We're also able to include adaptation projects in sectors such as energy, water, and transport. The project selection process is done in conjunction with the sector specialists and Treasury Department. Specifically, we follow the joint MDB report on climate finance tracking, as well as the additional selection criteria as part of our Green Bond Framework, which is available online. And the net proceeds from our green bonds are placed into a sub-portfolio within Treasury, which are dispersed to the eligible projects as and when required. Now, the fourth pillar of our Green Bond Framework, and as well as the Green Bond Principles, is reporting. And that's something that's been highlighted a lot already. But reporting and transparency have been key requirements from the investors that we have been speaking to, who require a clear line of sight between their investment and the impact the project is creating. So how we do it is we release an annual newsletter, which reports on the projects that are being financed by ADB, as well as the impact. So greenhouse gas emissions avoided, installed capacity, annual energy savings, and so forth. Okay, there are the slides. Again, what has been talked about is the MDB harmonized framework for impact reporting. This is something that ADB also joined up to, as it was something we found investors to be crying out for. And this is, again, something that I encourage any other issuer to look at and take seriously. Reporting, that's something very, very important for investors. If you can flick a few more slides, that's okay. The next one, please. This slide shows our latest green bond offering this year. Actually, we issued a dual tranche, 1.3 billion green bond in 3- and 10-year parts of the curve. I think we were one of the first supranationals, in fact, to do it in this kind of fashion. That 3-year transaction priced at around mid-swaps plus 1 basis points, the 10-year priced at mid-swaps plus 33 basis points. Something that we've also found from investors, from discussions with investors, is that pricing of green bonds needs to be in line with our regular global benchmark offerings. Next slide, please. Here are a few details of the inaugural green bond transaction we did earlier last year. That was a 10-year transaction, priced again at mid-swaps plus 1 basis points. We had some 44 SRI investors participate in that transaction. And what's interesting is about green bonds is that we've had investors who specifically wanted their names mentioned in the press release of this transaction. This is not conventional for regular transactions. So, and again, it highlights how perception is around this product. Green bonds are really perceived to be something very different, and investors want to be shown to be participating in a transaction. Again, I can go through those investors, but they are available on the press release online. Next slide. Actually, the next 2 slides just give you a couple of examples of projects we've been financing with the proceeds. This is a geothermal project in Indonesia for $250 million. Next one, please. And this is a wind power project, $20 million in the Philippines. Where next for ADB? Well, we are committed to be a regular green bond issuer. we are committed to issue annually in the US dollar space. We are also looking at other markets. We have been eyeing up the Australian dollar market, but currently finding perhaps the range of dedicated SRI investors in that space to be much more limited than in US dollars. But we're also looking at other local currencies in Asia. INR was mentioned earlier. China, of course, is a massively growing space, and we have a massive pipeline available in China, which we could potentially finance with green bonds. And yeah, any other markets that we find either beneficial for us in terms of diversifying our investor base, or cost-effective in terms of raising funds, is something that we look at on a regular basis. So that's an overview of what we do.
Oh, well, thanks, everyone. So we're now going to have a panel discussion. We've heard of the imperative that I mentioned, and it was much more clearly articulated by Jonathan. We need to get these funds flowing. We've also heard from developing member countries that the institutional frameworks need to be there. There needs to be a bond market before there can be a green market. You need governance. All these things need to be in place in order for the private sector to actually engage in green bond markets. We've heard from the MDBs about some of the frameworks and structures that they use to issue green bonds. But I guess I'm going to put this vexing question to the panel. And actually, as someone who's been involved in the climate change area for quite a long time, you know, this question's being asked over and over again now at every conference and seminar I've been to. And we still don't have the answers, but, you know, how do we get from where we are now to where we need to be in order to address this issue in such a short period of time? And I might start that difficult question. I might reference that difficult question to Christopher, who's been who's with EIB, who we now know with the issue of the first bond.
It's only friendly rivalry, you understand. I actually think in the last couple of years, the evolution in the market, the entry into the market of new players, and the acceptance of some of the framework arrangements, be it the principles, be it the methodology for measuring impact, and the acceptance of the need for regular reporting on those methodologies. These are the kind of cornerstones from the issuer side, and indeed perhaps from the investor side. Clearly, in individual country cases, there will be gaps which have to be filled in. As Professor Rahman said, you can't have a green bond market until you've got a plain vanilla bond market. I think it needs to be actively promoted. It needs to be actively marketed. This fixed income market is by far and away the biggest pool of capital in the world. Currently, the green bond market is 1% of the fixed income market, 1%. So if we could just get that to 2 or to 3%, that would be a dramatic increase in the currently available volumes. And it would allow, and this is something which isn't always obvious. We tend to hand over our pension funds and our bank accounts and our savings to professional managers, and we assume that they're competent and that they know what they're doing. But actually, when it comes to this stuff, to green, a lot of the time, people don't. People are still struggling, even the professional money managers, and they do need help on that. And these green bond principles and the reporting that goes with those principles, I think, can be important to bringing in more players into the market, because all of a sudden, to be a player is less complicated, is less intimidating than it used to be.
So I guess the question that comes from that is, how do we help? That's open to everyone.
Everyone. In terms of developing the green bond market, I mean, I completely agree with Chris's comment there. Is we have to build on the momentum, and that's why the actions of the EIB and ADB and the other pioneers should be applauded. We have to take that forward now. We have to drive somehow the champions out to market, to persuade them of the benefits of the financial benefits of sustainable investment, help them to understand that sustainability is not just a growth story. Sustainable growth is the only growth story. So this engagement, and when we do get to a situation, and we can see this starting to happen already, that once you get the leaders going out to market, you move from this situation where prospective issuers are not thinking about it because they don't see the benefit, but actually start to think about it for the sheer factor that they fear that they're missing out on something. So when Link REIT went to the market and got their 5-year deal away at 145 basis points just back in July, we had every Hong Kong property player ring us up and say, how did they do it? How did they do that? Was it green? Was it because it was green? And we said, well, we think the green was a very important positive factor. So we are sort of, I think, approaching now this tipping point where we start to get private sector investment moving into the markets, and the green bond is simply just a platform to help the private sector players tell their story. So that would be my answer on the green bond point. But the fundamental point, again, as I mentioned when I spoke, is if we want this investment to happen within the time frame within which it needs to happen to avoid the disaster, which I think most of us in this room recognize is imminent, we have to put a price on carbon. And that goes beyond the bond markets and is a much broader debate. But I think if we do that and mobilize the capital, we will succeed.
Yeah, to go in the direction defined by Jonathan and Christopher, I think that the most important point about green bond is to remind that it's a market. Green bond principles are not legal requirement. They are common understanding principles to set up a market. There are needs, financing needs, and the question is how finance is going to answer to these financing needs, and how finance it will be able to create its own ecosystem to find new investors that would be interested. When we first started this green bond fund, we thought it would be a decarbonization tool for institutional investors. Now, within a year since we started, we have been contacted by private bankers because high wealth individuals could be interested for their own decarbonization of their way of life, or simply because they want to have not something different from traditional financial product, but something that provides more than a financial profitability. And typically, when I say that it's a market, sure, we started with CO2, and I insisted on these tons of CO2 avoided as an indicator. But what I'm sure of is that in the future years, there are going to be more indicators and more impact indicators to provide this competition, because competition is the social dynamic of the market. And so some green bond fund would be helpful to solve waste problems, others will be focused on climate change, others would be diversified, but then we're going to have a competition and a social dynamic of a market.
I just wanted to build on Jonathan's point, because he's absolutely right. We keep forgetting about the fundamentals, and none of this is going to happen if we don't get carbon pricing right. That's absolutely fundamental. In this part of the world, there's another fundamental, which is fossil fuel subsidies. And that too needs to be addressed, because with those two opposing forces, opposing the decarbonization, that is, you're basically pushing a rock up a hill at the moment, and that makes, and that's an additional penalty on what is often technology which may be cost disadvantaged because it's new and still evolving. So far what we've talked about today has been what I would call the positive pull. We've emphasized the positive reasons for promoting this market, the green bond market, and why it's a good thing. Also, don't lose sight of what I would call perhaps the negative push. We talked yesterday a little bit about disclosure for financial investors. At the moment, there is not nearly enough information available to investors about the risks of business as normal. If it had been, people would not have put their money into the American coal industry and seen 75% of that go into Chapter 11 in the last couple of years. People would probably have put much less money into the American oil and gas industry, which has now got $235 billion of junk debt sitting there. This disclosure, much better quality and mandatory, I think it has to be really mandatory, is going to be essential if risks are going to be correctly priced and decisions are going to be taken on a properly informed basis.
I really agree with Christopher. I think if you want to raise a child, you got to know the village. You need the whole village to raise the child. So you need the whole country to really go green if you really want that. And for that, you need a huge change in the mindset, not only of the policymakers, the regulators, the bankers, even the citizens, as he was talking about. So for that to happen, I think we need, large programs of educating our stakeholders. And, this lesson learning can be really backed by organizations like ADB or other multilateral organizations, or through their technical assistance support. And also we can learn from each other in terms of exchange visits and know what is exactly going on. What are the advantages? Say, for example, we talk about masala bun, but we really didn't know how this mechanism was created, how to avoid the exchange rate risk. So those kind of educational programs are necessary. And at the moment, as I said, the younger generation actually, if given this proper indications, they would really opt for a green bond because they really care for their motherland, they care for the mother nature as well. And if you really want to develop an inclusive, sustainable finance, let's really kiss the pyramid of that finance. And these are small investors, individual investors, and institutional investors as well. So we need to really unbundle, as Christopher said, over the fossil subsidies and others, how these are really holding us apart, and then we take it forward about the green messages that we are giving here. Thank you.
Yes, and I would just really like to emphasize Professor Raman's point of education. I mean, the number of conferences that we have attended within Treasury during the course of this year to speak to, well, not just investors, but other issuers attending, educating them about what is a green bond, what are the risks of stranded assets and so forth. I mean, this is really crucial to try and get more players into the market, both on the buy and sell side. So for us, I mean, creating this kind of a forum and educating investors about, what we are doing in this space, I think can really help drive this market forward.
Well, thanks everyone for those answers. It's interesting to hear that the view that the market needs to wait for carbon pricing and for a removal of fossil fuel subsidies to work, and also perhaps even relying on behavioural change. I personally think all those things are going to take a long time, and I wonder if the drivers of this market can actually wait for those things to happen, But are there not other opportunities to proceed anyway? In the private sector department of ADB, we helped a company in the Philippines issue a green bond. It was a verified climate bond, and it was the first bond in this region for a long time. So we didn't need a functioning bond market to do it, and we didn't actually need to be in a country where green focus is currently prominent. So I actually challenge that we should wait for those things, and so that's really in the spirit of this debate, and I'd like to hear some comment on it.
No, we like a good challenge, Noel. I'll attempt to speak on behalf of all of the other panelists to my left. I don't think any one of us suggested wait for anything. Quite the opposite. Act now. In carbon terms, I said we need to get our foot on the brake and press hard now, immediately. But I did predict, and I do fear, that unless we actually put a price on the very commodity which is, the avoidance of which is essential to addressing the problem, I don't think the markets will get there in time. So we have to do both. And if collectively, in a sense, we need to get on to those who represent us and demand that they look at and review those changes to pricing of carbon. But in our day-to-day business as well, we are sparing no effort in trying to do exactly what Anthony described, going out there and explaining to our clients the challenge, the issue, the science, the problem, the imminence of that problem, and asking them to act now and suggest they raise green capital now. You'll never hear a debt capital markets banker advise their client to wait a bit. It's always now.
Fully associate myself with what you just said, Jonathan. As individual actors, we can't do much about fossil fuel subsidies. That's the prerogative of governments. Governments have political constraints, and we can only hope, we can lobby, we can push, we can explain, but we can't actually fix it ourselves, any independent economic actor, private or public. What we can do, however, is something about carbon pricing. Again, we can, if the market isn't performing, market isn't performing. But every financial investor, every major corporate can apply an internal carbon price, a shadow carbon price, and they can take their decisions based upon a kind of a stress test. What would that investment look like if the carbon price were not $6 a ton, which it is at the moment, but $30 a ton? It's something that we in EIB have done now for 6 years, 7 years, and we have found it a very powerful way of driving our investment decisions towards low carbon solutions.
A very pragmatic solution to this question is also, and I would develop a bit my idea of market dynamic. If we can ensure in Asia an end market for this green bond, meaning that in your bank you would find a green bond offer, I mean, that would be a good way to incite companies to issue a green bond. And if I may, how many of you in the room would refuse to choose a green bond fund if it provides the same financial performance plus an environmental performance? How many of you would refuse that? No. So maybe the solution is to create this end market so that Asian banks propose green bond funds to Asian customers, and then Asian companies would issue these green bonds.
That's what we want. That's what we want. Okay, well, thanks very much, everyone. I'm just going to open it to the floor now. We've got about 15 minutes for questions to the panel or observations. Does someone have mics? Can you come to the mic in the middle? When-
Have any derivatives been developed yet for the existing green bond market?
So the question was whether or not derivatives have been developed for the green bond market.
Not to my knowledge.
No, not to my knowledge. I mean,
You see
Hello.
matures that they will become a part of it?
well, the thing with the green bond is really the only difference to a normal bond is it's about the use of proceeds. So in terms of financial returns, it's the same ability to, hedge those. The same derivatives would apply to a green bond as would apply to any other fixed income instrument. If your question is, are there derivatives developing in the market where you can take a financial interest in some form of sustainability outcome, then the answer is I haven't seen any.
But also traders, they thrive on spreads between instruments. So if the green bond is a new market with liquidity, then there's a spread there between institutional, same names, as well as comparative industry.
Yeah, but usually when you run a green bond, it's more a kind of buy and hold strategy. And you can sell it if you don't trust anymore the company because of the reporting is poor or because there is no reporting. But it's a buy and hold management. We're not traders, we're investors.
Actually, what I was saying before about how green bonds generally price in line with the regular benchmark bonds holds true. So you usually find that green bond offerings tend to be slightly smaller than the benchmark transactions, and they're tightly held, as highlighted. So liquidity is actually a little bit thinner. So you can see that spreads perform in the secondary market a little bit more for the green bond, but it's more perhaps because the bonds are very tightly held and hard to get hold of.
It was the secondary market that I was
Right.
referring to. Thank you.
And again, could you introduce yourself before asking the question?
Paul Zaman. I'm just interested in moving away a bit from green bonds to just principles of responsible investing. And earlier we had the question of how are we going to stimulate more green bonds? So I guess the question is, how do we stimulate more pension funds, superannuation funds to use the principles of responsible investing? Because surely that is more mainstream, and here we have climate bonds, green bonds, which are a smaller component. So how do we tackle the main bond market to do more responsible investment, choosing that type of side, corporates who they want to invest in because it's more responsible? Thank you.
I think through things like PRI and the Carbon Disclosure Project and other advocacy groups, which are all pushing for greater disclosure and greater understanding of underlying risk, pointing always a finger to carbon stranding and ecological stranding and the other asset stranding risks which face. The educational process, the lobbying process is going quite strongly ahead. I think the green bond principles are kind of a further step in that same spectrum, if you want. And not everybody is going to need to go all the way to a green bond principle. But that intermediate stage, the 60 trillion, I think it is, of PRI money, which is accepting some form of CSR guidance now and some rather modest level of disclosure is I think it's quite a powerful first signal. And as Noel said, the momentum is there, the momentum is building, and I think it's probably past the point of no return at this stage.
Again, regulators have a role here as well. If the central bank really assigns that a part of the pension fund or the sovereign wealth fund need to be earmarked for the green investment or a green bond, that will automatically create a market. But problem with the developing countries that they don't have a pension fund well developed, except their civil servant pension fund. So you need to have a universal pension fund and then develop it and give a portion regulatory guidance for that. Secondly, you can also encourage in countries like Philippines or Bangladesh. There are in Bangladesh perhaps 16 billion remittance really coming to the country, and these people who are really working abroad, they are really keen about their motherland, their futures. So they would be happy to really buy some of the green funds, green bonds, if we really can project it that way. So I thought the regulators and the government have a role to play in directing the way you are wanting.
Shortly, green bond has been historically inspired or pushed by responsible investment. Principle of responsible investment in 2015 launched an initiative called Montreal Carbon Pledge, where investors had to measure their own portfolio emissions or carbon footprint of their equity. Now, once you measure, you want to go further and maybe to reduce it. And that's typically where green bond could play something. But I'm not sure this historical model has to be replayed and repeated everywhere. Maybe the Asian investors can just say, well, the green bonds as such have some interest because it connects with this impact investment, which is much more spread throughout Asia. So we could directly get in green bonds without necessarily using all the CSR small talks that were already evoked earlier today and yesterday.
3 answers to your question. How do we mainstream this? Disclosure, disclosure, and disclosure. This is issuers putting out there how they are addressing the fundamental risks that their business are facing, sustainability and the transition to a low carbon economy. And the green bond is actually nothing more than additional disclosure masquerading as a new product, masquerading as some form of financial engineering to get extra attention, to make it an extra and more efficient platform just for telling your story.
Thank you, that's a great point.
Yes, I was looking for. I just want to try and balance the current gender imbalance in this discussion at the moment.
Okay.
So good for. Please introduce yourself first.
My name is Devi Bramono. I'm from APP. What I want to ask the panelists is, I've seen a lot of examples for green bond on projects such as alternative fuel, renewable energy, and also energy efficiency. In developing country Indonesia, such as Indonesia, where there's a significant source of greenhouse gas emissions is from degradation of forests and also peatland. I'm just like to know if there's any green bond project related to that for deforestation and also peatland management, and if not, why is that? What is the barrier? What is the challenges?
EIB as an institution, but actually many other players in the market, have initially felt more comfortable in the renewable energy and energy efficiency space. It was easier to do the impact reporting on, it's easier to get a ring fence around the asset. It's generally a more manageable kind of an asset. And so it's in those sectors and those areas that the first standards have been worked out. I'm going to give Jonathan a quick plug here, because if you haven't seen it, this is a good document sponsored by HSBC, produced by the Climate Bond Initiative. And in there you can see, you can download it on the website, but in there you get a sector by sector status report of where the different standards have got to. So there are one or two others that have come out now. The low carbon transport is now out. Water is work in progress. Buildings and industry is there's a rule there. I'm not sure it's going to stay there for very long. And agriculture and forestry is also a bit work in progress. It's quite a complex one there.
Can I add something to that? Actually, water is out.
It is out, is it?
The Victorian government did a combined bond mass transit, renewables, and water. And I can also add, I'm taking the advantage of the moderator spot. My personal experience is if you can identify a project and take it to an organisation like the Climate Bond Initiative and say, here's a project, we need the standard, you'll drive the creation of that standard. And once the standard's there, then you should be able to issue the bond, provided that there's a market for the bond.
And if I may, IFC has issued a green bond specifically on RED plus, REDD plus projects, and one was related to Asian forest, and there's a competitor of Jonathan Drew in Europe that told me a month ago that he's working with Indonesian stakeholders to set up precisely a green bond on forest management, meaning investing in enabling the tribes, the people to stay around the forest so that there is no deforestation.
Okay, thank you very much.
Thanks for that question. We have time for another couple, I think, down the back. Did you want? Yep. Please introduce yourself.
Good afternoon, I'm Tim Bennett from Managed Growth in Australia. My question actually relates a little bit to the previous one. We're particularly interested in agricultural green bonds for funding more sustainable farming systems where carbon sequestration is incorporated in the process of productivity. My business is in the agricultural sector and we have a massive deal pipeline. One of the issues though, that's part of the question. The other part of the question is that debt doesn't always suit these sorts of things. Coupon requirements on a regular basis aren't necessarily very well aligned to nature. Have you looked at any sort of hybrids or any opportunities for quasi-equity in these sort of sectors?
I mean, just on the first question, and sort of, as you say, it's really a follow-on from the previous question. I think the answer, as my colleagues have said, it really does come down to complexity in the agricultural sector. There's no doubt that the capital is required. In terms of the, let's call it the vanilla green bond, the vanilla fixed income instrument, I mean, these instruments are typically, and the green investor base is looking for rated, typically investment grade, possibly high investment grade, and there aren't that many agricultural players fitting into that category. But as a matter of principle, there is no reason why the agricultural sector should not be an active, issuer into the green investor base. I know personally I've written green bond frameworks for two very significant Asian entities. They haven't chosen to issue in green format yet. They've actually arranged private placements. So I think the constraint there is really about the issuer willingness, and I think an issuer concern that when they have to deal with the particularly Asian issuers, Indonesian issuers, the sensitive palm oil sector, that they'd prefer to sort of manage those external issues through their certification and not add additional layer of complexity in terms of reporting that separately to investors. I suspect that's why they haven't moved forward. I'm not the right person to answer your second question. I'm a traditional, during my daytime, lending banker, and during the night time working with my debt capital markets colleagues on fixed income products, so I can't really talk to the equity component of your question.
Thank you.
I can give you a bit of a stab at the second part if it would help, because we do quite a lot of money, put quite a lot of money through equity funds of one kind or another, or sub-debt funds as well, including into the sustainable land use space, agro-forestry space. The standards we apply are exactly the same standards which have given rise to the practice which has now been exported to the green bond principles. So we don't look for anything different. It may be slightly less commoditized, of course, because these tend to be more individually structured operations, but the underlying principles of sustainability, of reportability, of ability to measure and therefore to manage are identical.
Thank you.
Maybe time for one last question. Oh, maybe we can fit two quick. If your question is quick, then we can fit two more in, because I think you've had your hand up for a while.
Shou Jingzhu from the World Resources Institute. I am based in China. Recently, the Chinese government released a guideline on establishing a green financial system. And in that, one of the policy measures is to encourage international cooperation, to encourage mutual opening of capital markets, which refers to issuing green bonds. So what do you think are the preconditions for mutual opening of a green bonds market? Now, for China, it's quite easy. China is flush with cash. Chinese companies could easily go to London to issue green bonds. But for smaller countries, it's quite a problem. Thank you.
Try and answer that question concisely. I mean, in terms of the green element of green bonds and having an open international market, I think the challenge there, which is not a big challenge, is actually just conforming the standards globally. So you've got the green bond principles internationally, and then within China you've got really the three regulators of the different part of the capital markets in China, NDRC, PBOC, and NAFME, all who have green bond statements. They're all slightly different, but they're not miles apart. So I think in actually conforming a global set of green bond standards, we're actually very, very close. And I know that Marjun at the PBOC is very committed to try and drive towards an increasingly standardized approach. In terms of global capital markets, of course, for international banks, there are, of course, licensing restrictions on who can do business in the China markets. And the Chinese banks and the Chinese securities houses are very keen to restrict the number of foreign players who have access. So there are some much broader, there are some issues there around the globalization of those markets and the ability for foreign issuers to tap into Chinese capital, which go way beyond just the green aspect.
Okay, this is the last question.
Jürgen Lorenz from Pro Environment Consortium. I have two questions, actually, short questions regarding the cost for bonds, green bonds. We have the experience from Germany. There are two instruments which are in the place through private placements, through bond issues and also equity. And those tenures are actually offered at lower conditions compared to conventional finance. So are your mechanisms you offer providing lower cost for refinancing through bond structures? And are you also looking into offering equity instruments through an instrument you could create? Another question is, I think the present problem putting or increasing the volumes for green bonds and the green finance is actually driven by the lack of consciousness of decision makers worldwide of the urgency of the problem we're facing. And is that not the main stumbling block? And if we remove that, I think green finance and green bonds would immediately shoot up in the market.
Well, to answer your second question first, absolutely yes, 100% agree. On your first question on pricing, and I think Anthony touched on this earlier on, the pricing proposition for green bonds is that at the date of issuance, they really price along the yield curve of the issuer. So the pricing is fundamentally the same. There's some who argue, and there's some evidence that some come in a bit cheaper, some come in a bit wider, but the economic proposition of a green bond, if you're an issuer, is that you issue in green format, you get your green story out there. That will then be monetized over time as your bonds start to trade tighter than your peers who do not have a sustainable story and who aren't engaging investors in the same way, such that when you go back to the market in future, you will be able to issue at lower yields, lower coupons. And the proposition to the investor is that you buy the green bond on day one, and as others have said, you get the greenness for free. So the market isn't pricing it. That's attractive to investors, so that bond will outperform other bonds that on date of issue may have looked equivalent, but because you get the green, because you're buying an issuance by a winner in this transition to low carbon, again, that yield will tighten and the value of that bond in your portfolio will rise, and that will give you a superior investment performance than had you bought the equivalent black bond at the time you wisely chose to buy the green bond.
Yep, so just to echo Jonathan's point, he's absolutely correct. We issue green bonds, we find them to be quite cost attractive for us. And in fact, if we were to issue green bonds tend to be issued as a smaller size than our regular benchmark transactions. They come in line in terms of pricing with the regular benchmarks, but normally, if it was a regular bond at that kind of small size, you would have to expect to pay up a little bit for it. So, in fact, we're getting a little bit of improved pricing just because of the smaller size, if you think about it that way. On your points about private placements, we do issue green private placements as well, and those do give us much better cost of funds than our benchmark curve, but we kind of need to have a benchmark curve as well to have that pricing reference in order to be able to issue those private placements. And private placements, by definition, are much smaller, much smaller in size. So the volumes that we need, the pipeline that we have in the green bond portfolio, we need to be doing that in public benchmarks.
Okay, thank you.
Okay, well, thanks everyone. I'm just going to really quickly summarize what I got from this, and that's that there is an imperative, that in DMCs there are structural impediments to a green bond market and even a bond market, that it's part of a framework of programs and policies. It may well depend on a price on carbon and the removal of things like fossil fuel subsidies, but that shouldn't stop the driving forward of the green bond market anyway. To me, the most important key message, the take-home message, is one made by, I think, Jonathan, that it's not a new asset class. It's an asset class that is already there. It's just a matter of labelling. And in many cases, it's very easy to label these asset classes. So, to me, that's the message, that it's easier than people think, and it's not new. Would anyone else like to add anything to that? Okay. Well, I'd like everyone to put their hands together for the panel. Thank you.